Okay, riddle me this, Oracle. Yeah, the sleepy database company your dad's accountant swore by just quietly signed up $638 billion of future business. That's not a typo. Biggest backlog in its entire history, up 363% in a single year. And when it announced all that, the stock fell, and it's kept sliding, now down nearly two-thirds from its high this year from $345 to $120. Record-shattering demand, and investors sprinting for the exits. Same company. So what do they see that the headline number doesn't? Grab a coffee. Let's scout it. Here's the plan. No fluff. 4 stops. We meet Oracle, and the number everyone's arguing about, we run it through the health check for red flags, we sanity check whether the stock's cheap or expensive, and this one has a twist you will not expect. Then we read the chart for what price is actually doing. Meter fills in as we go, final red held to the end. Ground rule, informational, not advice. You make the call. Deal, let's go. So who is Oracle? For decades, Oracle was the database company on the boring, bulletproof software that giant companies and governments run their guts on. Your bank's records, an airline's bookings, a government's payroll. Odds are an Oracle database is humming underneath, and that business still pays the bills. Fiscal 2026 revenue was $67.4 billion, a big slice of it the sleepy, renew every year software support that just shows up like clockwork. But that's not why it's in the news. That's OCI, Oracle Cloud Infrastructure. In plain English, Oracle is renting out warehouses full of computers so other companies can train artificial intelligence. Picture Oracle as a landlord for AI. It builds the buildings, wires the power, racks the chips, and leases it all out by the hour. That landlord business grew 77% last year and 93% just last quarter. For a company this old, that kind of growth is genuinely rare. And it's exactly why Wall Street can't stop talking about Oracle right now. Now, the number everyone's arguing about, $638 billion. That's Oracle's RPO. Remaining performance obligations. Total accountant speak. So let me translate, because this one word is the whole episode. RPO is the tab. It's everything customers have signed contracts for that Oracle hasn't delivered yet. Imagine a restaurant that took 2 years of reservations in a single night. The demand is unreal if the kitchen can cook it all. Oracle's tab jumped 363% in a year, most of it giant AI deals. So why did the stock crater on numbers this good? Short version, and we'll earn it in the next 2 acts. The results were great, but investors got one look at how much cash Oracle is burning to build all this, and bolted. That's the tension. Let's go see it in the numbers. Real demand, real acceleration, a genuinely exciting top line. Now, is the engine underneath healthy? Here's how I check any company for trouble before I ever look at the stock price. The business quality gauge. Think of it as a quick physical, a handful of vital signs. Pause and guess the grade if you want. A C. 65 out of 100. Not an elite compounder, not a disaster. Solid, with something dragging it. Let's find the something. First, ROIC, return on invested capital. The company's report card for turning $1 of investment into more than $1 of profit. Above 10% is genuinely good, and Oracle clears 10 across every window, 1 year to 10. Real strength. Clean bill of health there. Growth. Revenue up 17%. Earnings per share up 34% last year. For a company this old, a legit reacceleration. Green and green. Sounding like a B+, right? Here's the flag. Free cash flow, the vital sign that matters most. So stick with me. It's the money a company has left after paying to both run and grow itself. The cash it actually keeps. The scoreboard. And Oracle's just went red. The math is wild. Last year, Oracle made a record $32 billion in operating cash. Hugely positive. Then it spent $55.7 billion in capital expenditures, mostly building those AI warehouses. 32 minus 55.7 leaves you almost $24 billion in the hole. Negative $23.7 billion in free cash flow. Red flag alert, but let's be fair about which kind. This isn't a company bleeding cash because nobody wants its product. It's the opposite. It's spending like crazy because demand's so high it's racing to build capacity. An ambition flag, not a decay flag. But real cash is going out the door today for revenue that shows up years from now. And to fund it, Oracle's leaning on outside money. Last year, $43 billion in new debt, $5 billion in new stock. This year, about $40 billion more planned, including roughly $20 billion from selling brand new shares. New debt means interest to pay. New shares mean every existing slice of the pie gets thinner. That's dilution. One more flag. Because it rhymes with everything else, book value per share, the company's net worth for each share you own has barely grown over the long haul. 10-year view, it's red on the scorecard. On its own, not a deal breaker. But next to negative free cash flow and all that new debt and stock, the theme is loud. Oracle is pouring everything it's got into this build-out. One clear strength, returns, two flags, negative free cash flow, and weak long-run book value, both from the build-out. Business quality, a mixed bag. All right, good but mixed business. Now the question that decides everything, is the stock cheap or expensive? And here's the twist I promised. Value this one way and you get the wrong answer. You've got to look through a couple of lenses. Lens 1, the obvious one, value Oracle on the earnings it's reported over the last year. Do that and even a generous read tops out around $98. Stocks at $120. Looks overpriced. But here's why that's the wrong lens for this company. Oracle just spent $56 billion building AI capacity, and that spending slams its reported earnings right now through depreciation. So today's earnings badly understate what Oracle's about to earn once all that capacity switches on. That 47 to 98 range isn't the verdict. It's the floor, what the stock's worth if the growth never shows up. So lens 2, the one that actually fits a company mid-build-out, value it on what it's about to earn. Analysts have Oracle's earnings climbing fast from about $8 a share next year toward 20 plus. And when you put today's price against next year's expected earnings, the stock trades at just under 15 times. 15 times earnings for a company growing those earnings 25–30% a year? That's not expensive, that's cheap. On that forward basis, fair value comes out around $139, above where it trades today. Quick sanity check, is 15 times cheap or rich for Oracle. Its own 5-year average is 34 times earnings, so right now it's trading at less than half the multiple it usually gets. Cheap versus how this exact stock normally trades. So put the back up the truck fantasy price aside, the one that never comes, and here's an actual decision. Forward fair value about $139. A reasonable place to start, a fair price, not a steal, is roughly $111 to $125. And where's the stock right now? $120, sitting right in that reasonable zone. Not a screaming bargain, not a jackpot, a fair entry if you believe the growth. Now, always stay tuned. I'm not selling you free money. That whole forward case requires the growth to actually arrive. Oracle has to turn that backlog into real earnings while it's burning cash and stacking on debt. If the build-out stumbles, that trailing earnings floor, down around 47, is the gravity underneath the stock. So this isn't cheap, back up the truck. It's reasonably priced for a real growth story with real downside if the story breaks. And the pros are split on exactly that. Guggenheim and D.A. Davidson are focused on the cloud delivering, and they like it here. Wedbush's Dan Ives worried the debt turns it into a tug of war. Same stock, two honest reads, a rare thing for a stock down this hard. On forward earnings, it's reasonably priced and cheap versus its own history. The value is genuinely here if the growth shows up. The whole risk lives in that if. So exciting story and a price that's actually reasonable if the growth shows up. The chart's the tiebreaker. What is price actually doing? No opinions. And the chart does not care about your feelings. 3 things: trend, structure, momentum. First, trend. These two lines, the 50-day and 200-day moving averages, are just the average price over the last 50 and 200 days, a way to smooth the noise and see direction. Think of the 200-day as the tide line. Oracle at 120 is far below both, the 50 days near 170, the 200 near 187, price under both, faster line below slower. That's a downtrend and not a subtle one. Zoom out. This stock touched $345 in the past year. It's 120 now. It's given back almost the entire run. Whatever the story, price has been heading one way, down, and it's a firmly established downtrend, not a wobble. Second, structure. This point and figure chart. Ignore the X's and O's. It's just a noise filter that only marks a real move and skips the daily wiggles. It's read. A confirmed downtrend, a sell signal sitting on support around 114, with overhead resistance up at 154. So trend and structure agree. Down. Third, momentum. And here's the nuance that keeps us honest. Two gauges. RSI, the Relative Strength Index, is a speedometer for recent buying versus selling. Under 30 is oversold, stretched like a rubber band. Just recently, Oracle was deeply oversold. It's since bounced. RSI's back around 33, still soft, but not screaming stretched anymore. The second gauge, MACD, compares two moving averages to show whether momentum's improving or getting worse. And here's the twist the data shows. I won't hide it. MACD just ticked above its signal line, the first flicker that selling might be easing, and there's an early bullish divergence. Price kept dropping while momentum quietly stopped getting worse. So bottom, not so fast, Biraki, because that flicker conflicts with everything around it. Trends still down, price still below both averages, the point and figure structure still a confirmed sell, and money flow, whether buyers or sellers are in control, still shows sellers winning. One flicker of green against a wall of red. Honest rule works for any stock. This flips from still falling to actually turning when price climbs back above that faster average, and the structure breaks out over 154. One flickering gauge isn't a trend change. Until they line up, the chart's answer stays, not yet. A firmly established downtrend, with the first unconfirmed flicker of momentum. Trend, structure, and money flow all still down. Not a bottom, yet. Before the verdict, one honest counterweight, because everything so far has been about the here and now, and Oracle's a 30-year-old public company. So we back-tested it. And the headline finding matters over the last 32 years, simply buying Oracle and holding a return north of 5,000%, and when the test threw every timing trick at it, oversold bounces, momentum signals, the works, none of them reliably beat just holding. So let me say the important part first. What you're about to see is not a buy signal, not a system, not advice. It's a backtest. Hypothetical, and the past is not the future. With that said, here's the one genuinely interesting pattern. Historically, buying Oracle when it was beaten down like it is right now did better than average over the next couple years. On average, any random day, the next 3 years returned about 74%, but after the kind of down 20% from its high condition that's flashing today, the 3-year average jumped to about 117%. A handful of those beaten down conditions are flashing on Oracle today. But hold both ideas at once, because this is the whole point. Short term, the trend's still down and you don't fight a falling chart, even with the price finally reasonable on forward earnings. Long term, this has been a name where patience beat timing every time. Which one matters to you depends entirely on whether you're thinking in months or in decades. That's your call, not mine. Okay, let's put it together, because this one's genuinely interesting. The bull case isn't a slogan. OCI grew 77% last year, and that $600 billion backlog is real contracted work. Demand's not the question, the business is productive. but burning cash to build, leaning on debt and new shares. And here's the part that surprised me. After a drop of nearly 2/3, the price is finally reasonable. On next year's expected earnings, it's cheap, trading at about half its normal multiple, sitting right in a fair entry zone. So for once, the value's actually here, if the growth delivers. The catch is the chart. It's still in a real downtrend that hasn't turned. So here's Scout's field report, and it's the unusual kind, where the fundamentals say interesting and the chart says not yet, and both are right. The price is a fair bet on Oracle turning that backlog into real earnings faster than the cash burn and debt drag it down. Reasonable, not a steal, with a downside floor way down around 47 if the growth stalls, but the tape's still falling and you don't fight a falling chart. So this isn't overpriced, ignore it. It's the opposite of a chase, a strong name at a fair price that's still under pressure. One for the watch list. Let the chart confirm before you act, and you get a scheduled scoreboard. Around mid-September, Oracle reports. 3 things I'm watching, and you can too. Does cloud growth actually hit the 58 to 64% the company guided? Does free cash flow start climbing out of that hole? And how much new stock got issued? On the chart, simpler. I'd want to see that faster average reclaimed before I'd believe the downtrend's over. And honestly, tell me I'm wrong. If you think the market's right to pay up for that growth, make the bull case in the comments. I read them, and this is exactly the kind of stock that's fun to argue about. That's the read, but it's a read, not a recommendation. This channel is informational only, not financial advice. The numbers here are a starting point for your homework, not a replacement for it. If this made Oracle actually make sense, do me a favor and subscribe. We run one of these every week, and drop a ticker below. You name it, I'll scout it. See you next one.